Investing. When people think about it, the first thing that comes to mind is day trading, staring at stock charts, and potentially losing all of your money. But none of these things are true, and it doesn't have to be complicated. Once you understand a few basic concepts, you could become a millionaire in your lifetime. This is the video that I wish I saw when I first started on my investing journey, because it would have saved me a ton of time, money, and stress. The first thing that I wish I knew is that on average the stock market will return about 8 to 10%. So this is a very consistent return, but it's nothing amazing, and you're not going to be retiring overnight or become a millionaire in a few weeks from investing into the broad stock market index. But what does that return actually mean? If we be a bit more conservative and say that the market will return on average 9% per year, it just means in 8 years you're going to double your money. If you invested $50 for 30 years, you would have $327,000. And if you invested $200 per week over that same 30-year time period, you'd have $1.3 million. Because the stock market is represented by something called the S&P 500, which is just a collection of the biggest 500 publicly traded companies in the US market. If you think of big brands like Apple, Google, Facebook, Tesla, all put together into one investment, and there's no one actively managing this fund. There's no one picking out which company is going to be put into it. They're all just included based on their market cap or the total size of the business. This is really helpful because you don't have to lose out on any management fees, and the majority of the returns will just go to the investors. So with this, these examples are really impressive, but it's over a 30-year period. These aren't over 3 months or even 3 years as well. So you have to have a really long-term perspective. And in the stock market, time is your friend if you're picking out a well-established company and you have a lot of time, say 5-10 years plus, to hold on to that investment. I like to think of the S&P 500 as a high interest savings account. I'm not going to be constantly checking the returns that I make day by day, month by month. Not even much more than once or twice a year is going to be more practical. I always thought that the market was about finding the best new hot stock, getting in really early and selling it after a few weeks. You're trying to make as much money as you can in the shortest amount of time. Realizing that the market was about finding one investment and just consistently adding into it and holding that for decades was really surprising to me, because I would have never thought that holding onto one stock for virtually forever was going to be a winning strategy. If you want to invest in the S&P 500 yourself, you can't put your money directly into the index. Instead, there's ETFs or exchange traded funds, which are made by large investment companies like Vanguard and BlackRock, who will create their own ETF product that will perfectly match the performance of the S&P 500. So the one that I personally like to use is Vanguard, or VOO. So if you put VOO next to the stock chart of the S&P 500, you can see that their returns are exactly the same. The second thing I wish I knew is not to pick out an actively managed fund and put all of your trust into a fund manager. Normally they can't beat out the average market return of about 10%. Very occasionally they can, but if you put this average across, say, several years at a time, you're gonna most likely be losing out, and by quite a bit. Warren Buffett famously made a bet with a hedge fund saying that the S&P 500 index would outperform the actively managed fund, and that all the fees charged by the fund manager were essentially a waste of the investor's money and wouldn't give you a superior return to the overall stock market. This bet went from the beginning of 2008 on January 1st to the end of 2017 on December 31st. After that time, Warren Buffett's portfolio was worth $2.2 million, whereas the hedge fund was $1.9 million. So there was about a $300,000 difference between the two investments, proving that Warren Buffett's point was true. Paying a 1% fee to a fund manager can really change the returns that you make, and that fee compounds over time and gets greater and greater the more money that you're investing. It might sound like a little bit on paper, but in the long run it's really going to eat away at your profits. And knowing that the best strategy isn't just to trust someone else with your money gives you as the investor a lot of power and confidence in the returns that you can make, and that you don't actually have to have decades of investing experience to be able to make a good return from the market. The third point is not to just follow hype. There's always a new and exciting investment that's available. Most recently we had Pepe, and there was also Shiba Inu and Dogecoin as well. So I personally started to put my money into these speculative investments back when GameStop was really popular. In about 3 weeks, the price of the stock went up over 1700%, and during that time I was able to put in some money and I made $1,600. So this was a bit of a double-edged sword because it was really exciting making that amount of money almost overnight, but it did reinforce the habit of buying more of these investments. So GameStop worked out well for me, and there was so much hype around it. It was almost everything you saw in the investing community. It was on the news. There was a whole Reddit forum, Wall Street Bets, that was posting about it, and people were showing some massive returns. One guy even paid off his entire student loan from investing into GameStop. So during this time I was getting a bit greedy and I didn't cash out that $1,600. Instead I put in another $5,000, and thankfully I had put in a stop loss order where if my GameStop shares dropped by more than 10%, they would automatically be sold, because after that, when I went to bed, the stock price had a huge drop. In the weeks following that investment, it came down over 80%. So thankfully that stop loss order initiated. And GameStop was quite different, because normally when you have such a big jump in share price, the value is eventually going to have to come crashing down. You can't have a stock go up 1700% in just 2 weeks and have that massive run be continued. But after GameStop crashed, it shot up another 550%, which normally doesn't happen. I mean, great for anyone who invested a bit late and got caught holding the bag when it had dropped at 80%. They were still able to make some money, but of course many other people are going to invest at the top of that second pump and then lose out all of their returns. Currently the stock's lost over 80% of its value and the share price is only about $15. Number 4 is that a recession or a market crash is completely normal. On average, the stock market will crash or lose about 30% of its value every 8 years. I always thought that when the stock market was crashing, it meant that everyone was losing all their money, the world was ending, and that the idea of putting your money into the market was extremely unsafe. I had wanted to start investing for several years before I actually took the first step and started, because I always saw on the news that the market was crashing or there was a recession or that there was some huge financial issue. So it really puts you off ever getting started and putting your money into the stock market in the first place. Of course, there is a possibility that you will lose money in a market crash or a correction, but knowing how often they happen really helps you be prepared for them and not think they're such a big deal. I'll share some data from Market Sentiment about recessions, and I'll leave the article linked below in the description box as well. So from 1945 to 2020, if you held on to the S&P 500 for more than a year after a recession, on average you would have a return of 18%. If you held it for 3 years, you'd have an average return of 46%, and if you held it for more than 5 years, you would be up 120%. So if you're keeping in mind that recessions are normal and the main thing you have to do is not sell when the market drops, then you're going to be okay in the long run. On average, the market will drop just over 29% during a recession, and there can be times where it falls even more than this. In 2007 to 2009, it came down 57%, and in 2001, it dropped 49%. So it's easy to say that a recession is normal and it's part of the normal economic cycle, but seeing such big drops in your investment value is going to be pretty hard. You might not be directly invested into the S&P 500, but all companies follow that index to some degree. Depending on the size of the business, they might have a larger or higher drop in price, but overall, if the S&P 500 is losing value, so are all the other stocks in the market as well on average. And even huge multi-trillion-dollar companies like Microsoft, Apple, and Facebook can lose 30 to 70% of their value as well. But in the long run, they bounce back and regain their value, but you're never going to get an investment that goes up in a perfectly straight line. There's always going to be ups and downs along the way. There's so many other things to know about stock market investing, like how to pick out the best companies, the best investing strategy, and how to actually set up a brokerage account and start buying shares of a company. If you want to see a complete step-by-step guide on how to do all of these things and more, then make sure to check out this video on screen that'll show you how to get started on your investing journey as a complete beginner.